Hello everyone, my job is to make school easier, so today I am going to make accounting easier by learning basics of accounting. If you like our video, kindly like, share and subscribe. Comment and subscribe. So I'm going to start with the basics in accounting. Accounting is the process of identifying, measuring, and communicating economic information to permit informed judgments and decisions by the users of information. So, when you look at the definition of accounting, it's a process. You have to identify those transactions that are of economic value, you have to measure, and at the same time, once you've measured, you have to communicate that information um, to users of the same information. So you ask yourself, who are the users of accounting information? Users of accounting information are categorized into two. We have internal users and external users. When you look at internal users, there's that information. Once you process all the accounting information in form of reports and all that, the managers and the owners, these are the managers, basically the employees of the organization together with the owners. So they would need to know how the farm is operating and all that. So in that case, that one, in other words, falls under management accounting, and those ones are categorized as internal users. The other category is external users. In this case, you may have creditors and lenders, employees and their unions, customers, government units, and the general public. All those ones are external users, such that the moment you are done with the moment you do financial accounting, all the information that is available to the public, basically to anybody who may be having an interest with the firm, they are categorized as external users. So you ask yourself, uh, for instance, in form of when you look at the creditors and lenders, they will be interested. For instance, these ones includes the banks and all that, and other financial institutions. Should a loan be granted to that particular firm, will the company or the firm be able to pay its debts as they become due? So they will be seeking to answer that particular information, and that information they will get it from the financial accounting. And these ones still falls under external user. The other thing are the employees together with their unions. In this case, these are the trade unions. So you ask yourself, does the company have the ability to pay increased wages? Is the company financially able to provide long-term employment for its workforce? So by that, they'll be able to get that information from the reports that they'll be accessing from wherever they are. The other example is, for instance, the customer. Customers, they're interested with knowing whether the company is in a position to offer useful products at fair prices. So they ask themselves, will the company survive long enough maybe to honor its product warranties? Yeah, because for a customer, they don't want to be in a scenario where the moment they purchased a product and they are given those product warranties, maybe for 15 years or 10 years or whichever the period, and if the company is not performing well, probably the company may be short-lived. So they will be really interested in the financial performance of that particular firm. The other example of the users is the still falling under external user. We have the government units. So they ask themselves, if the company, such as a local public utility, are they charging a fair rate for its services? Yeah, so these ones they'll be able to know when they are doing all the pricing and all that. It will be reflected from their financial reports. The other interested party is the general public. So they ask themselves if the firm is providing useful products and gainful employment for its citizens without causing serious environmental problems. The general public are really interested in knowing if the company, if the company are just interested in providing products and probably just employing people without factoring in mind the environmental problems that they may be incurring as a result of they'll be encountering from their operations. So the general public would really be interested in that. So let's go to the accounting process. The accounting process has a process. First, when you look at the accounting, being that it's a process of identifying. You have to identify, is this one a financial transaction or not? Because you are really interested in capturing the financial transactions because they have some economic value. So the first thing that you need to do is to enter that particular information in a source document. In this source document, the source document, it could be a voucher, it could be a receipt, it could be a bill. That all those documents, they are source documents. They have the information that you'll be really interested while doing your account. The second process is to journalize. You have to journalize all the information that you've captured from the source document. You have to put it in a journal. So that one is the second step that you really need to do. Then from there, you'll go to the ledger. From the ledger, you'll be able to extract balances. They could be debit or credit balances. And once you've extracted that, that's what you'll use to prepare the trial balance. So then from the trial balance, if it balances or not, yeah, we'll be looking at that far much later. Yeah, because it may balance, and that one is not it does not give you a clean bill to say that all the postings have been done properly. So but generally, once you've checked for errors and all that, then you'll prepare your financial statements as the last stage. And these ones, from the financial statements, you need to prepare a profit and loss. You also need to prepare the balance sheet, or rather the statement of financial position, a cash flow statement. You'll still prepare from once you have the information from the trial balance. Then you ask yourself, there's this question that arises. There's a difference. What is bookkeeping? Bookkeeping is it's just a mechanical process, and it entails entering the information from the source documents to journalizing to posting from the ledgers, then extracting the trial balance and all that. So from the source documents to the trial balance, this is what you refer to as bookkeeping. And that's what a bookkeeper does. So he does from from capturing the information from the source document all the way to extracting a trial balance. The other thing that you need to know is the elements of accounting. So you need to understand what is an asset, what is a liability, what is owner's equity, what are revenues and expenses. So from there, once you are able to tell what all those ones are, like for instance, you'll have the expenses. These are business properties. They are business properties. They must be of economic value, and from there you'll still have some economic benefits by the firm owning those properties. So in this case, they could be maybe machinery, it could be buildings. Yes, they are owning that property, and they are owning those ones are assets they own, and they also get economic benefit from owning and controlling those particular assets. So once you know, that one will dwell on that farmer later. Then we need to understand what is a liability. A liability is a future economic sacrifice, and you are obliged to make. When you borrow money, you have to create a liability. Similarly, if you purchase an item on credit, that one falls under accounts payable. Someone could have delivered a service to you and they have not yet sent a bill. This will be an accrued expense. So all that, anything that the firm is owing to anybody, that one is a liability, and it is the opposite of an asset. An asset is what the firm owns and it controls, and from that it is able to generate, to get some economic benefits. So but for the liability is what the firm, it could be in form of a borrowing. Basically it's what the firm owes to anybody. It could also even be a bank. Then you go to the other element of accounting, which is the owner's equity. For the owner's equity, this one is the residual interest in the assets of the entity. So the moment you have all the assets, all the firm owns, then you minus, you subtract all the liabilities, what it owes out anybody. So whatever residual, whatever remains is what you refer to as owner's equity. And so that one, as I had put it, it is the difference between assets and liabilities.